Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner and owner of Elevation Financial. Thanks for joining me today. Glad you are here as always. Today's discussion, everything you need to know about quarterly estimated taxes. Oh boy, taxes. Talked about taxes recently. I feel like a lot lately. Taxes can be stressful, lots of rules, lots of regulations, lots of stuff to keep track of. Our tax code is insanely complicated in the US. For business owners, this is even more of an acute issue. We have more stuff to worry about as business owners, lots of other rules and regulations that apply. And one of those things is quarterly estimated tax payments. That's something a lot of business owners have to kind of worry about and kind of manage. So we're going to talk about that today and kind of run through a complete kind of overview of quarterly estimated taxes and give you a deep dive into how everything works. So let's start by defining what are estimated quarterly taxes. These are tax payments made by individuals to the government on a quarterly basis to cover your tax liability. It applies to those who are self-employed, freelancers, small business owners, independent contractors, anyone who does not have taxes automatically withheld from income. So the estimated quarterly tax system requires you to pay your tax liability as you go on a quarterly basis because our tax system in this country is a pay-as-you-go system. You're supposed to ideally pay taxes along the way throughout the year as you earn income. The issue is, since business owners and self-employed individuals don't receive W-2 income, or if they do, it's not all of their income, meaning they receive some income outside of W-2 payroll, that means there is a need to pay taxes manually, so to speak, through the quarterly estimated tax system. You're kind of paying it directly because payroll is not taking care of it. So, if you're taking an owner's draw or distribution, or just being paid directly as a contractor, that's not going through payroll. You have to pay the taxes manually along the way through the quarterly estimated tax process. Also, it's worth noting that it's not just business owners. I'm primarily talking to business owners, but also retired individuals who get their income from other methods like interest income, for example, that doesn't go through payroll, also are required to pay quarterly estimated taxes. So basically, any income that does not go through payroll is subject to quarterly estimated taxes. In general, I should say. All right, so let's dig a little bit deeper into that. Who is required to make quarterly estimated tax payments? So typically the following individuals commonly do need to make quarterly estimated tax payments. Business owners of an LLC or a sole proprietorship, again, paying through owner's draw or just kind of direct payments, they're subject to quarterly estimated tax payments. Business owners of an S corporation, typically, especially if not all your payroll is going through, or all of your income is going through payroll. 1099 contractors and freelancers, again, being paid directly and not through payroll. As I mentioned before, retired individuals with income not being, that does not have taxes withheld, such as retirement income, investment income. Generally, anyone receiving income not going through payroll. That's who is subject to needing to pay quarterly estimates. So if any of these scenarios apply to you, quarterly estimated taxes might be something you need to stay on top of. And again, why is that? It's because taxes are not being withheld from your income automatically. If a client writes you a check or pays you directly in some way, you receive 100% of that income at the time it's received. But a portion of that income belongs to the government already. And because remember, it's a pay-as-you-go system. So you need to pay taxes as you go in the form of quarterly estimates. So is there a threshold on how much income you need to make before you need to pay? Generally, yes. If you're a business owner, a self-employed, et cetera, freelancer, and you expect to owe at least $1,000 in federal income tax for the tax year after you subtract any withholding and refundable credits, you might be required to make quarterly estimated tax payments. So the general threshold guideline is about $1,000 in tax liability before you need to start paying. All right, next, when do I have to pay quarterly estimated taxes? Taxpayers are required to pay estimated taxes on a quarterly basis on a schedule that is determined by the IRS, and the due dates for these payments are as follows. April 15th is the due date for the first quarter, January 1st through March 31st. Next, June 15th is the next due date, and that is for payment from April 1st to May 31st. Now, Yes, I know this is not technically a quarter. It's earlier than you would expect. You'd expect it to be in July, but no, the IRS defines that a second quarter as April and May. So for whatever reason, June 15th is the next payment. So that's not a misstatement. That is correct. June 15th is the next quarter's payment. September 15th is the next quarter's due date. And then January 15th is the final quarter for the last quarter of the year, due January 15th of the following year. Those are your due dates. Note if any of those due dates fall on a weekend or a holiday, the payment is due on the next business day. Also, be sure, this is a good time to mention, be sure to consult your tax professional for the best route to go in your situation on, what to pay, how much to pay. I'll say this more than once, but this is meant to be an educational guide, not tax advice in any way. So be sure to consult with a tax professional for advice in your specific situation. Which is a great segue into how to calculate quarterly estimated taxes. Again, disclaimer, consult a tax pro for your specific situation, but here's the educational overview. So calculating estimated quarterly taxes can be a little tricky. The ideal scenario is to work with a tax pro, but there's a few approaches you can take when calculating these tax payments. So one approach, which is an attempt to be the most accurate, is the full calculation of forecasting income, doing deductions, and getting a final number. Another method is kind of the safe harbor method, which can be a little easier and has a different approach. And we'll kind of talk through both. So to calculate your estimated quarterly tax payments with the most accuracy, you'll want to estimate your taxable income for the year minus deductions and tax liability for the current tax year. I'm sorry, deductions and credits. And here's kind of the steps you go through to calculate that. First, estimate total income for the year. This includes all sources of income, wages, self-employment income, interest, dividends, rental income, et cetera, all income. And then determine allowable deductions. This includes expenses related to business, supplies, equipment, et cetera, as well as deductions for personal expenses like charitable contributions, mortgage interest, stuff like that. Then you calculate your AGI, your adjusted gross income, by subtracting your deductions from your income. And then estimate your tax liability based on your AGI at the current tax rates. And the IRS does have tax tables and calculators to help you with this, so you can get use some of those formulas, and then determine the amount of tax you've already paid during the year, including tax withheld from paychecks or other income, and then subtract the amount of tax already paid from your estimated tax liability to get your estimated quarterly tax payments you need to make, and then divide that by 4 to determine the amount for each quarterly payment. Obviously, a lot of steps to go through, but that's going to get you the most accurate estimate. Again, these are estimates. I doubt you're going to get it exactly right, but these are meant to be estimates, hence the name, estimated quarterly taxes. There's also a form. You can use form 1040-ES to calculate your estimated tax liability and make those payments. It includes instructions, it includes worksheets, as well as little vouchers to send in as well. So that's one method. Another method is just to use the safe harbor method. And this approach doesn't necessarily mean you're going to end up with the most accurate calculations, but it will help you avoid penalties. We'll talk more about penalties later. The safe harbor provision is a rule that can protect you from underpayment penalties if you meet certain criteria for estimated tax payments. So to kind of fall into the safe harbor provision and to avoid penalties, you can simply do one of the following. You can, one, calculate your estimated quarterly tax payments and make them equal to 90% of the current tax year's liability if you know what it's going to be. Or even easier, take last year's tax liability and just pay 100% of that. Or if you make over 150 in AGI, it'll be 110%. So that's probably the easiest method, because you're going to look at last year's tax liability, look at how much you paid in total taxes last year, and then divide that by 4 and make that the current year's estimated tax payments. And again, if you're over 150 in AGI, it's going to be 110%. That's your safe harbor provision. That's going to keep you from paying penalties in theory, and just give you a good general calculation for doing it by the book without penalties. Again, it's not going to necessarily keep you from owing extra taxes because your income might be different, but it is going to keep you from owing in penalties. So again, if you want to avoid penalties, you feel your income is pretty consistent from year to year, the safe harbor method could work well for you. And again, just simply look at last year's tax return, find the total tax paid, Again, multiply it by 1.1 if your AGI was over 150, and then divide it by 4 to get your quarterly estimated tax payments. There's some calculators online as well that can be helpful. There's no endorsement or affiliation implied, and no claims of accuracy implied by this. But I'm giving you just some FYI that there are some calculators out there. One is from Bench.co has a good one. There's one from Keeper. There's one from Acuity. One from Flyfin. So if you just Google, estimated quarterly tax payment calculator, and maybe plug in one of those names after them, you'll find these pretty easily. Again, no endorsement or affiliation implied or claims of accuracy. These are just for your reference. Also note that quarterly estimated tax payments apply to the household. So if you file married filing jointly, you're going to look at your total tax paid on your married filing jointly tax return. All right, next, how to pay quarterly estimated taxes. Since you've calculated your tax payments, how do you pay them now? One is you can go old school. You can mail a check to the IRS. Some people do this. You can do this by sending a check with your mail-in vouchers that are on Form 1040 ES. These vouchers have fields that let you specify the quarter the payment is for, as well as your personal identifying information. You mail that in with your check. But many people, including me, find it easier to pay online. I prefer this method. It's faster, it's direct, it's more secure, in my opinion. You can go to the IRS payment portal, which is irs.gov/payments. And you can make your quarterly estimated tax payments online using your bank account. Side note, if you haven't done this already, it's a good time to create an online IRS account so that you can track your payments and see your tax history online. So while you're doing that, go ahead and create an account online, and that'll give you good visibility into your tax history. So you might be wondering at this point, should you pay from your business account or your personal account? The short answer is you should typically pay from your personal account. Again, consult your tax professional for specific advice, but generally your personal account is the appropriate account to pay for. Why is that? Because most individuals paying quarterly estimated taxes are owners of what's called pass-through entities, which means that all taxes are owed by you as the individual, not the business. So LLCs, sole proprietorships, S-corps, all examples of pass-through entities. In these examples, the business itself does not owe taxes. The individual owes taxes because the business profit flows through to the owner's personal tax return. We use that term flows through as if it makes sense, but what it means is the profits and the income made by the business shows up on your personal 1040. The business does not owe the taxes. The income shows up on your personal 1040 and gets kind of all lumped together on your personal tax return. Now, that being said, many business owners in practice still pay out of their business account, and their tax pro or bookkeeper adjusts accordingly and kind of makes it work by, coding it correctly. But the correct way technically is to pay out of a personal account. And I've consulted with CPAs and EAs about this multiple times. They all agree that the technically correct way is to pay out of your personal account if you're a pass-through entity. So keep that in mind. Next, do quarterly taxes have to be paid on time? Yeah, they do. They're supposed to be paid on time to avoid penalties and interest. So the due dates, again, for quarterly estimated tax payments are April 15th, June 15th, September 15th, and January 15th the following year. And again, if all due dates fall on a weekend or holiday, or if any due dates, I should say, fall on a weekend or holiday, the payment is due the next business day. All right, so what is the penalty for not paying quarterly estimated taxes? So if you don't make quarterly estimated tax payments, the IRS can assess a penalty for the underpayment of estimated taxes. The penalty is calculated on the difference between the amount of tax you should have paid and the amount you actually paid minus any refundable credits. So they take the difference of what you didn't pay, or the difference of what you paid versus what you should have paid, basically. So the penalty is calculated on the federal short-term interest rate plus 3 percentage points and charged on a quarterly basis for underpayment. So let's say in 2023, the interest rate is 5%, plus 3. That's kind of the general guideline of what the penalty would be on a quarterly basis. And again, a reminder, to avoid the penalty, you want to pay 90% of tax owed for the current year, or 100% of the tax owed for the previous year, or 110% of the previous year if your AGI is over 150. Do quarterly taxes have to be equal? Not necessarily. They do not have to be equal, but they should be based on your estimated tax liability for the current year. So if your tax liability is projected to be, unequal amounts, as you go throughout the year. Again, we're a pay-as-you-go system, then your quarterly payments may be unequal as well. If you're going by the safe harbor method, though, it might make sense just to simply pay each quarter in equal amounts because you're dividing by 4 anyway. So that can be fine as well. All right. How do you plan for quarterly estimated taxes? I've seen this so many times. So many business owners get behind on their quarterly estimated tax payments because they haven't planned ahead for it. So, proper cash flow planning can go a long way toward helping you keep up with taxes, avoiding surprises, and steering clear of those penalties. And again, I want to say once you get behind on taxes, it can be very difficult to get caught up. So, be sure to plan ahead for this. So, the first step is to calculate your quarterly estimated tax payments for the year. Then, in your personal budget, assuming you're paying out of your personal accounts, as we talked about, set aside enough in your cash flow to fund a tax account that you'll use to pay your quarterly estimated taxes, including your state taxes. So, more on that a little bit later as well. I like this to be a separate bank account, and move that money into that separate bank account. It's out of sight, out of mind. You've already flagged it as belonging to the government. Is a great way to keep that separate. Then, when each payment is due, make the payment from your tax account. That way, it's already been set aside and the quarterly payment doesn't come out of your cash flow. So, setting aside separate accounts can be a great way to organize your bank accounts to plan for not just quarterly estimated tax payments, but other large expenditures as well. Now, what if you own multiple businesses? If you own multiple businesses, the guideline is still the same. Remember that, again, if your business is a pass through entity or all your businesses are pass through entities, you pay the taxes, not your business. So, all income from all sources add up to result in your total income. So to see how this works, you can look at your tax return where you can see all your income eventually combined into one amount. So again, if you own, let's say, 3 LLCs, and each LLC makes a profit, all that profit together aggregates into your personal income, and all that is used to calculate your quarterly estimated tax payments. Because again, the payment is due from you as a person, not your businesses. All right, what about state taxes? Whether or not you have to pay quarterly estimated taxes at the state level depends on the state where you live and work. So I can't go into too much detail here because it depends on state by state. Some states require individuals who are self-employed or have business income to make quarterly estimated tax payments. Others do not, but they do require them to pay their full liability by the end of the year. So lots of different rules state by state. So to find out whether or not you're required to make estimated quarterly tax payments at the state level, check with your state's tax agency, or better yet, consult with your tax professional who is familiar with tax laws in your state. Be sure to learn what your state's tax rate is, and look at your previous state tax return to get a sense of how much your state tax liability is. All right, you want to stay current on quarterly estimated taxes to avoid complications. So, wrapping all this up, I want to really caution you and encourage you how important it is to stay current on quarterly estimated taxes. Helps you avoid complications that can arise if you don't pay enough or pay late. So, to recap, here are some of the reasons why staying current on quarterly estimated taxes is really, really important. Avoiding penalties. You don't want to pay more than you have to. If you don't pay enough or pay late, you might be subject to penalties from the IRS. The penalties can be a lot sometimes, and they can add up quickly. So be sure you stay on top of it. Managing your cash flow. Paying quarterly estimated taxes helps you manage your cash flow and avoid a big tax bill at the end of the year. By making smaller regular payments throughout the year, you can avoid that large lump sum payment and better plan your finances. Also, it helps you avoid audit triggers. Failing to pay quarterly estimated taxes can also be an audit trigger. If the IRS notices that you're not paying your taxes on time, they might decide to audit your business to investigate further. Accurate budgeting is also a factor here. So, staying current on quarterly estimated taxes can help you accurately budget for your business expenses and your personal expenses too. By knowing how much you'll owe in taxes each quarter, you can better plan for those expenses and investments you have. So, to wrap, staying current on your quarterly estimated tax payments is really a great way to lower risk, have some peace of mind and keep your financial situation strong. I cannot count how many times I have worked with business owners, and one of the biggest issues they have is cash flow and debt problems because they owe taxes to the IRS because they have not kept up on quarterly estimated tax payments. So I bang this drum all the time. Stay current on quarterly estimated tax payments, make them on time, make them part of your systems, and you will avoid a world of pain from a tax standpoint if you keep up with these things. So, hope that's been helpful. As always, I'm happy to chat about this or anything else on your mind. You're welcome to reach out on my website, which is elevationfinancial.com. You can send me a note, or even better, you can book a complimentary money session using that big friendly button on the homepage. And happy to chat. Pop in your top 2 or 3 questions you want to talk about, and I'll be happy to give you feedback. And it is complimentary, as the name implies. So with that, thanks so much for joining me today. Have a great day. We'll see you next time.